Hey, my name's Tim Dahlberg here with Burns Estate Planning and Wealth Advisors. We had a coffee chat coming to you this afternoon. We have a special guest, Senior Advisor Scott Gwatney. Today we're going to be talking about interest rates, how it's affecting, we've been hearing about it in the news, how's it affecting the economy, how's it impacting the portfolios, how's it impacting debt. We've heard about it in the news probably for the last, year and a half?
At least on and off. I mean, it's been very impactful, and I think the magnifying glass came on it after COVID. I mean, so as we saw rates drop to, from zero, and then we had to raise rates, and then now we're lowering rates back. So it's been in the news on and off, and I think, we're hearing more and more about it now for two reasons. One, the new administration that, just got into office, and two, Jerome Powell, the head. I mean, his contract's up in May of 26, so he'll be stepping out of office. And right now with the tariff talks, we've seen a big pivot over from tariffs. Now that tariffs have kind of, for the most part, started to come to the table, and we have clarity there. We see a little bit more focus on interest rates and inflation, and people are starting to wonder, are we going to make changes to where we're at with the current interest rates? And we've seen the pros and cons. It's a double-edged sword, as you know, Tim. I mean, it's if interest rates go up, or if, the Fed raises rates, we see our savings accounts. We're like, hey, instead of getting 0.5%, I'm getting 4%. That's right. That's a lot better than 0.5%. Absolutely. And then you go to buy a home, you go to buy a car, your credit card rates, you're like, hey, I got to pay 7% for an auto loan. I got to pay, 7% for a 30-year mortgage. You see one side, and I mean, as you know, when both sides rise, it can be beneficial and detrimental at the same time.
Yeah, that's right. And I think one of the things, and we probably get this, and you guys get this all the time, is how is it affecting, the portfolio, right? Most of the people that we talk to are thinking about retirement income. How can we stretch our dollars, okay? I mean, one of the things that interest rates, it's beneficial, like you just said just a second ago, as the interest rates are high. How can we use that as an advantage while the interest rates are high? What should people, retirees specifically, be looking forward to take advantage of higher interest rates now, knowing that they're probably going to be reducing or hopefully lowering here in the near future?
And that's a good question, because right now safety's been really good. And you look at CDs, short-term CDs are okay, long-term CDs, the further you go out, they're lower, just because of the way that the yield curve is right now. Maybe looking at bonds, maybe a long-term bond or a new issue bond that you can lock in this higher rate now, because if rates go back down, if a company's going to offer a 4, 5, 6% bond, if rates go back down, then they're going to go down as well. They're going to offer a 3% bond.
So it's better to take a shorter term bond, or if we're looking for a little bit longer duration or longer term bond to lock in the rate?
If it's a new issue, I'd go long term. Okay. Lock in that long rate, locking in long term. That's an option. But it's something that we're really going to kind of sit down and discuss with clients, because through the end of this year, if we have 2 rate drops at the end of the year, then, instead of being right at 4% for our money market funds, our savings account, we're probably going to be, 3.5%, 3.25%.
I did see that.
So, and then by next May, we don't know what to expect further than that. So I think now's a good time to start talking to your advisor and saying, okay, well, my safe money, my money market's been at 4%. I'm happy with that.
Yeah,
but if that goes to 3%,
what are some of the alternatives?
Exactly. We're still on track for our goals. Is our safe money really still producing as it should be? If it goes down to 2%, what other options do I have?
Yeah.
And that's one thing that, sitting with my clients, it's what's your goal? How much risk are you truly willing to take? And I tell them, don't sacrifice being able to sleep at night just to grab a little extra yield. If you're like, oh man, I don't know if I'm comfortable with this. Within your comfort zone, what does it look like? And if we need more interest, then maybe it's something like a structured note. Take a little bit more risk, depending on how it's structured, and then also getting, 7, 8, 9% there.
Structure.
Something to really sit down and talk to, your advisor about and see if that's an alternative to keeping us on track.
Okay. Going back to that, that's a great question, or a great thing that you brought up about the structured note. Can you talk a little bit more about the structured note? Is it similar to a CD, similar to a bond? Is that something that pays annually?
They can pay. The one thing about a structured note, they can be structured however you want. Ours is pretty, very, very plain vanilla, I would say. I wouldn't say, but it's something very similar, and we'll sit down and talk to the clients about that. But there are potentials to lose money. So I tell everybody, like, if you're looking at a CD or a money market or a savings account, those are about as safe as you can get. And then you look at bonds. Bonds do fluctuate outside, depending on how long you go. Structure notes the same way. They'll fluctuate a little bit as well. But overall, they're going to give us a lot better return. And that's something that we can kind of sit down and discuss with clients about, okay, well, is this a good fit? Is this what we want to utilize, in the long run? or maybe it's not, and then maybe we need to figure out another alternative that, hey, we don't want to go all the way into the market.
Yep.
We need more yield to reach our goal than 1-2% and save money. And we can look at, how to possibly structure those going forward. They do pay monthly income, so that's a benefit.
We'll look for our retirees. They're looking for the extra income.
It is good. So it's one of those things that we'll sit down and make sure it's a good fit for each client before we actually move forward with.
Perfect. Well, that sounds like a good alternative to CDs. If we know that Powell, let's hope he finally starts lowering rates. Yeah. He's been dangling the carrot for a number of months, probably getting into the years. CPI data has actually been coming down. I know tariffs, we thought it was going to affect it, maybe keeping it longer, but maybe 2 rate cuts will be good. So an alternative to the CDs, as you're saying, look for something else, maybe like the structured note.
Well, I think it's time to revisit that. If you have a large portion of your portfolio in safety, then I would say, okay, well, sit with your advisor and then say, hey, look, come in and sit with us. And I say, hey, well, this is good right now at 4%. I'm happy as a bug in a rug. But going forward, if we get down to 3.5%, I'm okay. 3%, 2.5%. Let's find an alternative to this. Yep. And that's one of the things that we'll kind of sit down with clients and talk about, if you're currently invested in that.
Sure.
When it comes to retirement planning, I tell everyone this, interest rates being as high as they are, inflation being as high as it is right now, sit down and look at saying, okay, well, instead of refinancing things, because if you have a 2.5%, 3% mortgage still,
it's going to ask you that one.
Don't want to refinance at 7%. If you're looking for a new home, I would wait a little bit longer and say, okay, well, here's what we're paying at 7%. If mortgage rates will kind of fluctuate and go down a little bit more, maybe 5% makes that home more affordable if you're buying a new home, or even if you're downsizing into retirement.
Absolutely.
I tell everyone, that's something to consider. And when it comes to debts, you've seen some credit card rates. I have seen clients say, hey, I used to pay 19%. Now I'm up to 23, 24, 27%. This is killing me. My interest keeps growing. And that's not all cards. I tell everyone, now's the time, especially for planning for retirement. Let's go ahead and tackle those, because just because the interest rates do come down, it doesn't mean that credit card company is going to lower rates back down to where you were comfortable to. So try to tackle that debt too when it comes to planning for retirement and get that off your plate.
And that's a great point. I mean, we bring it up, and we always talk about with retirees, one of the big things is debt. One of the things that we kind of hear about a lot, and you probably do as well, I have a mortgage, right? Maybe it's 3%, 4%, with the current interest rates being where they're at. Does it make sense to pay off that debt early? What would you say to somebody kind of asking those questions?
It depends. And I say it depends because it depends on a few things. Usually you can write off your mortgage interest, so especially on your main home. So that's a plus. That say, okay, well, if we're only paying 2% and we have X amount making 3, 4, 5, 6% here.
Doesn't make sense to pay it off early.
Doesn't make sense unless, and I tell everyone this, especially retirees, when they see that finish line coming and they got 3 more years until the house is paid off, we have the money set aside. I tell everyone, I can talk to you numbers wise. Why it makes sense. Hey, we're paying a 3% mortgage, we're making 6, 7% here. Just keep paying it through that. It makes sense. But it comes down to peace of mind. And I tell everyone this, if you're having trouble sleeping, and I've had some clients say, hey, look, Scott, I get it. Let's talk about it again. But I just don't know. I want to get this off my plate. I don't want to owe anymore. I want that house to be mine. There is a value of peace of mind. Yeah. And it gets to a point where if the numbers make sense, great. But if you're like, hey, I want a clean slate when I start off into retirement, even if this is 2-3 years to go, get rid of that because it doesn't make enough sense sometimes. Yeah. Now, sometimes if we're talking about taking a substantial amount of money to pay a house off, we'll have to sit down and talk about that. It's a situation by situation, and really client by client. Really just seeing if we pay this off, will it impact our retirement goals?
Sure.
And that's one of the things that we can sit down and we put a plan together for you and look at this and say, okay, if we do pay it off, here's how it affects. If we don't pay it off, here's where we are. And if it doesn't make a difference and it comes down truly to, Tim, I want to pay this off because I don't want to, I can't sleep. And it makes sense, then pay it off. So I tell everyone it's a case-by-case basis, but you're in a better position at 3%, having an investment and say, hey, I'm paying a 7% mortgage, should I pay it off? Well, I think that's an easier determination if the higher you are, but if you're still blessed to be in that 3% range, we need to sit down and talk about it.
That's right. If we can borrow low rates, cheap money, we would love it. Well, look, you brought a lot of great info, a lot of information that's here. And it sounds like as far as interest rates, income, let's hope that the interest rates are coming back down, get some more money back into the economy. We can start borrowing, be a lot better. Yeah. But we can find some alternatives to get that higher yield, that higher interest for those income.
Absolutely.
Well, folks, Great coffee chat that we had here. Thanks, Scott Gwatney,
Absolutely.
for sitting down with us. If you guys have any questions, anything as far as the retirement, if you have questions about interest rate, where we can start putting that money, put an extra few dollars in your pocket, give Burns Estate Planning and Wealth Advisors a call today, or visit us on our website, burnsestatePlanning.com.